Hi everyone. So today is actually going to be our last session for investment analysis, and we have been covering all the module learning outcomes during the past 9 weeks. And today I will be covering certain sections in order to ensure that all the sections that are in our module is covered. So basically, as you know, last week we were actually talking about different types of taxation. So today I will be continuing it as well. Excuse me, hold on. I just need to yeah. So now I hope, guys, I hope things are clear now. So so last week we were talking about different types of taxation, and today we will continue and talk about one of the main differences in taxation, which is the direct taxation as well as indirect taxation. Thereafter, what happens is I will be talking about this and how it affects investment decisions, why we are trying to study taxation in order to, while we are obviously doing investment analysis, the importance of doing that. I will be talking about that. And thereafter, we'll actually be talking about London Stock Exchange. So we've actually talked about lots of regulatory bodies, and there were a lot of bodies and how they operate. All of this we've been talking about during the past few weeks. However, thought it's that it would be helpful for you if I just separately take down this particular body and then kind of give you a better understanding to make sure that we cover all the sections under the learning outcome so that you can ensure that you have a broad knowledge of all the learning outcomes under this particular module. So I will be doing that today as our last class. So now let's move on towards what we are supposed to study today. So as you can see in this slide, we are first going to talk about types of taxation. So here, the two different types of taxation that we are going to talk about is the direct taxation as well as the indirect taxation. Now taxation can be direct or it could be indirect. And the difference between these direct taxation as well as indirect taxation differs in many ways. Like there are differences, there are tiny differences between these two types of taxation. But however, there's like one main difference between the direct and indirect taxation, obviously based on who pays the tax or who is paying the tax authorities. So basically, as you can see in the slide, so the main difference in this is the direct taxation. Is that the direct taxation is basically paid for tax authorities by the ultimate taxpayer himself. So basically, when it comes to the taxes, if it's an individual or even if it's a company, the individual or the company will pay the taxation to the tax authority. However, when it comes to indirect tax, so the person who buys the product, basically when it comes to indirect taxation, this mainly falls into all these the products like goods and services. So mainly when it is mainly products that we buy. Generally we go and buy. So these indirect taxes, like just think about it. Have you ever paid taxation when you're going to buy any product in a supermarket? No, you don't. Because the taxation is included in the product cost as like the product price as well as the manufacturer is paying that particular taxation amount to the tax authorities, because obviously it is like, is it something that can be done, like indirect taxes which are for the goods, could it be, taxed upon like from the consumer itself? No, it is going to be a bit of a difficult situation. Therefore, what happens is the taxation is conducted indirectly, and the manufacturer or like the distributor, depending on whether it's something that was imported, those people, those companies are the ones who will be straight away paying the tax authority in bulk based on what the product is and how much the product amount is. So therefore, does the consumer pay the tax to the tax authorities? No. So basically, the difference between the direct taxation and the indirect taxation is that when it comes to direct taxation, the taxpayer, the individual or the company, will pay it to the tax authorities. However, when it comes to indirect taxes, that does not happen. So tax authorities, what happens is someone in the middle, the manufacturer or like a distributor, will be paying for it. So as you can see, direct taxes are paid by the taxpayer, as I told you, to the tax authorities directly or deducted at the source. And direct taxes are based on income or profit. So now here I said that it is paid by individuals or companies. So now when it comes to direct taxes, if it's an individual, we pay based on their income, right? So like basically a person's income is being taxed when it comes to individual generally, and profits basically sorry. So when it comes to profit, what happens is obviously the companies are supposed to prepare the financial statements, and in the financial statement, they are supposed to calculate their profit. So based on the profit amount, a certain percentage is supposed to be paid for the tax authority. So basically, as you can see, direct taxes could be income, based on income, or it could be based on profit. So the other thing is that the direct taxes are basically progressive. So what we mean by progressive is that, when you have an income or profit which is less, the taxation amount is less. However, when the income or the profit keeps on increasing, what happens is the individual or the company needs to pay a higher amount, right? So as an example, now when it comes to individual, a person who earns a particular amount of, let's say a particular amount of earning from a company, employment salary. So what happens is if there is like taxation, so different countries have different taxation. So there is also something called pay as you earn for employees, where when they earn a particular amount per month or per year, till that particular amount, no one has to pay any taxes. And thereafter there'll be particular slabs in which a percentage of tax is supposed to be paid. So this slab, so when the income slab increases, the taxation amount also increases, the taxation percentage. So in that way, a progressive amount is being paid to the taxation authorities. This is basically because it is believed that a person who earns more needs to pay a larger sum to the tax authority. So that's why we say direct taxes are progressive. So second, we will be talking about indirect taxes. So indirect taxes are basically, as I explained to you, collected from the taxpayer as part of the purchasing price by an intermediary, such as a retail shop, and are ultimately paid to the HMRC by the intermediary. So as I said, it could be a retail shop, the VAT amount, or it could even be manufacturers, depending on how the country rules and regulation is. So basically, the person who pays tax is not the person who consumes the person who consumes the product. So indirect taxes are based on what people spend. So now here, another difference is actually, now direct tax is taxed. Well, for what are they taxed? Individuals or companies are paid for their income, right? However, indirect taxes, they are paid based on what you spend. So when you buy a product, what do? You just spend money to buy something. What you're spending, you're being taxed. So as you can see, indirect taxes are basically regressive. So we said that direct taxes are progressive. However, indirect taxes, they are actually considered as regressive. Do you know why? Because now low-income receivers end up paying like a higher proportion of their earnings to indirect costs, because obviously individuals would have their kind of needs and wants, and specific expenses are there. So if that is so, obviously the taxation related to that product needs to be paid by that low-income receivers. However, when you compare what you pay as a tax, as indirect tax, when you're buying your things for consumption, compared to your earnings, so obviously the low-income receivers will pay a higher amount, because a person who has a higher proportion of earning will not, spend a similar amount. Yes, they would spend, however, what they pay pay as indirect tax will be, so what they pay as a indirect tax will be less in comparison to their income. When you compare your income and then the indirect taxes that are paid by a high income person would be, would have like a higher proportion difference. So from the low income receivers, there'll be a higher proportion of like taxed amount compared to a person who has a higher income. Therefore, we call the indirect taxes to be regressive, while the direct taxes are considered to be progressive. So moving on. Hold on. Yeah, so moving on, we will be talking about the difference between indirect taxes and direct taxes. So as you can see here, direct taxes, first recipient is HMRC, obviously. Direct taxes, the taxpayer pays directly to the government, and indirect taxes, the taxpayer pay tax to an intermediary who then pays the collected tax to the HMRC. So basically, as I told, the main difference, the person who pays the tax differs. So based on, so direct taxes, as I told, it is based on income or capital, but indirect taxes are based on what people spend rather than what they earn. So difference is, direct taxes is based on income, while indirect taxes is based on expenditure. And now we also talked about progressive taxation as well as regressive taxation. So direct taxation is considered to be progressive. I explained to you how it became progressive, while indirect taxations are considered to be regressive. Okay. Now, when we talk about example, what are the direct taxation example? It could be income tax, it could be corporation tax, capital gains tax. So when it comes to regressive taxation, it differs country to country, but it could be the VAT, the value-added tax on products, or the stamp duty, or taxes which is levied on things such as alcohol and food. All these things are considered to be indirect tax. So I just hope that you understood the difference between these particular taxations. And now we have to kind of try and move towards impact of taxation on investment decision. So when I started off, I said, okay, right, I will be telling you why we are actually studying about taxation, right? All this time we've been talking something related to investment, like it was regulatory bodies or some kind of, different financial instruments, all related to investment analysis and things of that sort, or finance. However, now this is taxation. So generally what people think is, okay, right, taxation comes in with, something to do with accounting or something where you just account and pay for your income or expenses. So that's what I explained as well. However, one thing that we need to understand is it is vital for students who study investment decisions or, calculate things related to investment to know what taxation is. Specifically, the difference between this direct taxation as well as indirect taxation. Let me just kind of remind you of certain things that we did beforehand, which you might have just mechanically just done it out of probably because that's how it is done, because it's based on some kind of equation, you would have done it. However, now this is your time to kind of understand why we did this step. I mean, what we did over there. So now, just reminding you of what we're talking about, we did calculations such as NPV, right? So while calculating NPV, and we were calculating things such as written down value. So I, of course, did like a basic kind of calculation. However, if you had gone through more, more towards, how to calculate NPV, and when it's kind of like an investment, specifically if it's like a machinery. I'm sorry. So if it's something like a machinery, so what basically happens is, you would have noted that there was some kind of written down value that was calculated. While calculated, there would have been some tax, taxation amount that is added back and things of that sort. So all that was because of the taxation and how it affects the investment decision. Also, as an example, while we were calculating certain, we were calculating the earnings from the income that you get from certain, like even like derivative and different types of financing sources, there were situations in which we added back the taxation paid, or we calculated while we were doing some, there were sections where we just multiplied it by 1 minus 8. At that time, I would have kind of explained and said, okay, right, we are reducing the taxation amount or something of that sort. So now you should be able to understand how this particular thing works. Okay, right? If we are including a particular amount of taxation, you should be able to kind of figure out, okay, right, is it a direct tax or is it a indirect tax? How the taxation affects this particular investment decision? Or like when you're doing like, if you are supposed to kind of do some calculation based on investment decisions, then obviously, so specifically when it comes to investment decisions, okay, yes, there are specific ways in which you can do the calculation. However, related to the the company, we might, might need to adjust certain things based on the company activity. So then, good understanding about the taxation also will help, because there are situations where the taxation needs to be reduced. There are situations where taxation needs to be added in as well. So with that, we will try and understand how the taxation impacts investment decisions. Moving on. So as you can see, so every individual of any company is basically liable to kind of pay different types of taxation. So taxation would have both positive as well as negative impacts on investment decision. As I said, there is tax benefits that a person would get based on investment. There would be tax, amount that is taxable from the income that you receive from the particular investment. So the impact of tax could be positive for certain situations of certain companies, and it could be negative for certain situation or companies depending on the activity. So the impact of taxation on an individual investment commonly depends on how much an investor has to invest and how sophisticated an investor is. So basically, the amount that the investment, how much the person invests in, depends on the investor and the investor's characteristic as well. So moving on, as you can see, the different taxation rates can have an impact on how investors choose to invest in prevailing opportunities. So basically, the tax rates could differ based on who the investor is and the other opportunities that other opportunities that each investor has as well. So when it comes to taxation, it is paid on investment and can reduce the amount of earnings an investor makes from an investment which is undertaken. So on the other hand, some investments are tax based on capital gain, and some investors can try to take advantage of tax deferred investment or investment that offer certain tax advantages. So companies can kind of take depreciation on certain property. So this can be impact on how and when new items are purchased, because sometimes there are situations where companies who invest, specifically companies coming from a different country and invest in another country, will get a lot of tax relief, tax and particular amount of years where they don't have to pay any tax of that sort. So that tax benefit could be included as well. So the businesses are taxed based on the structure of the business. Hence, the owner investors focus on this fact and form business organization accordingly. Like example, because based on the structure of the business only, the taxation happens. Example, when it comes to a sole proprietor, who is paying the taxation? Is it the boutique or boutique name or whoever? No, it is going to be the owner of the boutique or the sole proprietor. So partnerships are also the same. However, when it comes to limited liability companies, it changes, because the investors are, obviously they'll be paying based on their investment and how much their earnings are. They'll be separately paying in income tax. However, when it comes to limited liability companies, for company decisions, the company is supposed to pay back, for their earnings, the profits and all that. That's why the financial statements are supposed to be prepared for all the companies, especially when it comes to so that the calculation happens really well. That's why mostly audited company accounts are considered to be important when it comes to companies. So that way, as you can see, we were just kind of trying to explain and try and understand the investment decisions and how taxation could, impact the investment decision. So moving on, we are going to talk about a bit of tax avoidance and evasion. This is just, a basic understanding for you all to understand, because the name sounds similar. However, there is a small difference between these two. So because we were talking about tax, I thought better if I just kind of make you all understand the concept and what it is. So tax avoidance and tax evasions are means by which people reduce it tax liability. So basically, when it comes to tax avoidance, it is legal. However, when it comes to tax evasion, it is illegal. So let's see the difference between these two. So when we look at the difference, what you can see is, so liability basically avoidance, like so liability of tax payment basically lies with each individual. So tax is basically considered to be like an expense by an individual. And so they would naturally kind of seek to reduce the amount of tax paid wherever possible. So when this tax mitigation method is done legally, then it is known as tax avoidance. But if someone does it in illegal methods, these are being sought to reduce tax liability, then it gives rise to a situation which is called a tax evasion. So basically, tax by avoidance is using legal means such as making use of tax shelters and arranging one's affairs according to minimize the tax liability, which is called tax avoidance. So basically, certain tax streams use the loopholes in tax legislation and introduced to disclosure obligations on promoters of certain tax avoidance. Now, when it comes to tax evasion, what happens is deliberately misleading the tax authorities to evade tax liabilities is considered to be illegal. This is what tax evasion is. So one way is providing false information. Providing false information to the tax authorities, or even concealing a source of income and not providing information to the HMRC. These are all parts of tax evasion. So basically, tax evasion is illegal, as I said. So tax avoidance is okay. So the risk of criminal prosecution by the fine or imprisonment is what happens here. So moving on, as I told you, we finished off the section about taxation, and I just hope that you will understand what this particular taxation means and how it will affect your investment decision. So we will be moving towards our last section, which is the London Stock Exchange. I want you all to get a better understanding of London Stock Exchange. Hi, so as I told you, we are going to talk about London Stock Exchange. So London Stock Exchange, or LSE, is the primary stock exchange in the United Kingdom, and it's also considered to be the largest, which originated more than 3,000 years ago. So what happens is, in 1973, the regional exchanges were kind of merged to form something called the Stock Exchange of Great Britain and Ireland. So it started with that, and thereafter, later, it was named at London Stock Exchange. So the Financial Times Stock Exchange, FTSE 100 share index of FTSE, is the dominant index containing 100 of the top blue chip stocks on the LSE. So stock exchange is basically physically located in the city of London, and in 2007, the London Stock Exchange merged with Milan Stock Exchange, the Borsa Italiana to form the London Stock Exchange Group, or LSEG. So before it was called LSE, but in 2007 it was changed into LSEG. Okay. So as you can see, London has been one of the world's leading financial cities, and it is kind of well known as a hub for international trading, for banking, for insurance, and like the history of the London Stock Exchange go back to 1698. So basically what happens is in 1698, a broker called John Castaigne began posting the prices of stock and commodities at Jonathan's Coffee House. So he started posting the prices, which was like a popular meeting place for businessmen to kind of conduct trades. So what happened was Castaigne called his price list the course of the exchange and other things. And so by 1801, it became clear that a formal system was needed to kind of deter these fraud and unscrupulous traders. So brokers kind of agreed to set a set of rules and paid kind of like a membership fee to belong to this particular exchange. So it kind of improved where a membership fee had to be paid so that certain things can be included. So paving the way for the first regulated stock exchange in London. That's how it started. And thereafter, what happens is, hold on. Okay, so when it comes to the primary market, LSE provides like cost-effective access to some of the world's deepest and most liquid pools of capital. So it is home to a wide range of companies, and it provides electronic equities trading for listed companies. So LSE is like the most international and all stock exchange with the thousands of companies from more than 60 countries. And it's like the premier source of equity market liquidity. And you can call it benchmark prices and the market data in Europe, and like linked by partnership to exchange in Asia and Africa. And it basically intends to remove the cost and regulatory barrier from the capital market world. So all that happens there. And another thing that we need to kind of understand is that in 1986, something else happened on October 26th. So basically when this was moving on, so there were members and membership were paid, and then, this particular stock exchange happened. However, the UK government deregulated the London Stock Exchange, known as the Big Bang, because of the massive changes that immediately ensued. So deregulation introduced electronic trading to London Stock Exchange, which kind of replaced that traditional type of open outright trading. And it was basically considered to be efficient and faster, and trading volumes will increase and for the exchange, so as the New York Stock Exchange. Hold on. So I was talking about the Big Bang. So this is where the government's kind of reform program to kind of eliminate over-regulation and kind of encourage free competition. And it is introduced to other significant changes to the structure of financial statement and on trades and removal, the separation between companies and trade stocks and those kind of things. So these changes kind of increased competition among the brokerage companies that led to a series of mergers and acquisitions. And another big change showed a foreign ownership of UK brokers and opened London's market to international banks as well. So now we are going to try and figure out the top companies on the London Stock Exchange. So as you can see, the biggest UK companies listed on the LSE as of the second quarter in 2022. The Shell is the first in line, and then comes AstraZeneca. Obviously, AstraZeneca has kind of improved. The company profile has improved with this COVID-19 and the related vaccination. So the other one would be HSBC, then Diego and Unilever. So basically, when it comes to equity issues, including things like IPOs and money raised, are generally included in this LSEG website and handle as well. So I was also talking about this LSEG website. So just let me kind of get y'all understand what LSEG website is. Just let me kind of help. Yeah. So what I would do is, as you can see, the LSEG, the company information. So you're supposed to know like different types of risks and different types of situation that had arisen to LSEG. Sorry about it. So the issues you will be able to kind of conduct here is so this has market products and services. Here how to raise finance and how data is analyzed, and technology, like different types of LSEG, technology group and technology market connectivity. All these sections are included in this LSEG website. So you will kind of get a better understanding by going through all these things and as well. I'm sorry. So this is the LSEG. Yeah, so let's kind of go to derivative. Okay, hold on. Derivatives. We talked about derivative. So it talks about market innovation in derivative trading, fixed income features, definitely MTF. These are things that are being kind of discovered or discussed here. And as you can see, the fixed income holders and the foreign exchange, all that will be included hereafter. So as you can see, so this could also include the commodities. Sorry. We also talked about access for the pool of international capitals and things of that sort. Okay, so we've kind of come to the end of the presentation, as you can see. Where is the presentation? Hold on. So we will be moving on towards so companies of that sort. So moving on, let me just kind of give you a better understanding of what happened. So we will be covering certain sections under here. So as you can see, here, we have access for certain sections, and we will try and see if this will kind of help. So as you can see, these are the sections that will be covered. Yes, so yeah. So as you can see, hold on. So what I would do now is, I'm unable to just do what I wanted to do. So what I would do is, As I told you before, one of the main reasons for doing all this is basically because we wanted to ensure that that all of us get a better understanding about the company. So, as I told you before, this is our last lesson, and we've been talking about investment analysis, and so I'm just gonna skim through the learning outcomes so that as you can see what is you're supposed to know understand the different types of securities, where you should be able to explain the types of security and concepts and evaluate key characteristics of each type. So this is the criterion. Thereafter, they have include the indicative content, so that the content that could be included in order to achieve this particular assignment criterion. So what you need to understand is there are 6 learning outcomes which will be covered under the question. So the second one is to understand the regulation of security trading and new issues in the world market. That's why we spoke about regulatory procedures and things of that sort. And today we spoke about London Stock Exchange to kind of understand how it also gets involved in the day-to-day work. So the other one would be able to apply principles of investment theory, securities, and market analysis. Obviously, we were talking about different methods of calculating certain sections where they have to know about principles of investment and the use of securities and things of that sort. And then move on, we are supposed to cover to understand the principle of taxation. Obviously, you need to know the difference between indirect and direct taxation and the characteristics of and things of that sort. And we've been covering all this during last week and this week as well. So the fifth is to understand the laws and regulations controlling the financial services industry. It's very important to kind of know the rules and regulations to ensure that you don't kind of mix up and don't pay or, don't consider. The last one, we be able to plan, manage, and assess client portfolio. So it is one of the things that is required and trying to understand. So as you can see, hedging, arbitrage, portfolio management, efficient market hypotheses, different types of taxations and methods and all that are included here. So from to understanding from whatever I taught during the past 9 weeks and today as well, you would get a better understanding of this learning outcomes, because one of the main things that they look for is for you to know, be able to cover basically all these learning outcomes. As you can see in the assessment also, they will be covering that as well. So as you can see, we also have indicative reading list. As you know, advanced in investment analysis and portfolio management is like one of really good books which talks about different sections. So obviously, as you know, we have been doing this class for 1 hour per week, and we've tried to cover all the sections in the learning outcomes. And so because we need to cover all the sections, I have not been able to kind of really go deep into the particular concept that I was talking about. What I really did was to try and ensure that you all of you understand at least the basic of each concept, so that you would know something about it, unlike not knowing anything at all. So you have these indicative readings. You can look and try and see whether you can get. There are journals and websites, which is actually very useful because they are giving you the list. So you can go through and kind of move towards it as well. So as we were talking about, different methods actually can be used here when it comes to investment analysis. And I hope that all of you got a really good understanding about the investment analysis. This is our last lesson, so we won't be able to miss meet again. Hopefully I would meet you with a different module. However, when it comes to the finance investment analysis, I hope that you got a basic understanding of each section, so that when they're looking for like a broader kind of concept, they could find it in the other assignments as well. So as you can see, it is very important to ensure that you know all parts of the investment, parts of the learning outcomes, because it will be tested as well. So guys, we've done with the content of the of investment analysis, and I hope that you did understood or understood what I explained and what I really wanted all to do. So as you can see, these are certain learning outcomes. I explained to you what we've kind of covered and not covered. So through we've been able to kind of complete all the learning outcomes, and obviously we won't be able to do a big analysis and write a lot. Be able to give a small subtle help when it comes to writing this particular section. So I just hope all of you had a good 9 weeks. I really don't know, there were particular situations in which my voice was gone when I was sick and things of that sort. I would like to apologize for not being able to kind of not being able to properly analyze based on what was in front of so as you can see, the investment analysis is very important, and I hope all of you got a basic understanding about the learning outcomes. And thank you very much, everyone. So it had actually been a very nice journey, and I hope all of you are able to kind of go through everything and do your assessments well. And it had been quite a pleasure trying to explain to you about different sections of investment analysis. Thank you, everyone. Have a good not day. I just hope that you have a good time after this. See you. Thank you for all your help, and see you, everyone, hopefully in another module. Thank you. Take care. Bye.